Welcome to Bloomberg Markets. I'm Shanali Basak. Stocks are sinking as a weak July jobs report is rattling Wall Street. We're going to check on these markets now because we're off the lows of the day for stocks, but still firmly in the red. The S&P 500 down more than 1.8%, almost 1.9%. NASDAQ 100 down 2.2% today still. The Russell 2000, remember, this is the trade that everyone was piling into for the last couple of weeks, now down almost 3.4%. That VIX just stunningly elevated, almost 10 notches higher than where we started the week, above 25. We're going to look a little closer at the NASDAQ 100, near correction territory from its peak on July 10th, down more than 9%, just a hair away from that 10% needed to be called a correction. But of course, after those big tech earnings, very ugly moves here on another very crowded trade. And some midday movers here on the equity side. Intel shares are plummeting. They are suffering their largest decline in over 40 years. This drop comes after the company announced a grim forecast and laid out plans to cut more than 15% of its workforce. It also is suspending dividend payments. It has paid a dividend since 1992. Meanwhile, Amazon shares are also sliding, its biggest intraday drop on more than a year. On an intraday basis, of course, the company told investors that it will prioritize heavy spending on AI over profits. Amazon projecting a range of operating income for the current quarter that falls short of analyst estimates, and you're looking at a more than 9% drop on Amazon throughout the day. When looking at this market volatility through the lens of credit, the North American Investment Grade Credit Index has spiked higher this week. The benchmark increases as credit risk rises, and it is now at the highest level since April. Credit investors are certainly keeping an eye on the Fed and these market moves, and Chicago Fed President Austin Goolsbee explained his perspective a little earlier in an exclusive interview.
I've been saying for months that what we wanted to see was improvement on inflation and especially improvement in the components like housing and services. And we've been seeing that. And that the longer we were restrictive, we're going to have to start thinking about the employment side of the mandate.
Now bringing in Danielle Poli, Assistant Portfolio Manager with Oaktree's Global Credit Strategy, and James Athey, Marlborough Co-Manager of Global Bond and Bond Income Funds. And you take a look at the jobs data this morning, and two words permeated the market, didn't it? It was growth, scare. Danielle, when you're thinking about the riskier parts of the credit market here, do you get a little concerned?
Thanks, Shanali. Great to be here with you today. You know, we just recently published our second quarter performing credit outlook piece, and we titled it The Dual Economy, owing to these risks that we're seeing in a bifurcated economy. And I'll just try and explain it simply as a tale of two consumers. You have, on one hand, the wealthy that have seen their asset bases grow with the soaring stock prices that we had seen. Record number of billionaires. And what this does is it's driven up prices in all asset classes, and financial markets have been booming. But then on the other hand, you have lower and middle income consumers that are really hurting. They're facing pressures from higher interest rates and high prices. Their savings are depleted. We're starting to look at credit card delinquencies back up at 2011 levels. And so we are seeing signs that the economy is weakening, importantly, in companies having this impact on their earnings. So it is very important, as always, to be an active manager and really underwriting those companies that we're lending to for a weaker environment that we see going forward.
James, it's really funny because when you look at the bond market here, of course, you've seen these very tight spreads. People have not really been concerned about the bond market. You're seeing now a severe movement in the stock market. You can ask the question, what is riskier right now, high yield bonds or the stock market that people have been following into for so long?
Yeah, I mean, notwithstanding what happened in Switzerland with the AT1 market, obviously, if you're an equity investor, you're at the bottom of the cap stack. I don't think many people are talking about the sort of large cap defaults that make you worried about that reality if you have been investing in Magnificent Seven or much of the large cap indices. But again, I think what's been forgotten in this whole conversation recently is just the risks that one is running and the compensation that one is receiving for those. So when you see a 10-year Treasury yield which is higher than the earnings yield on the S&P 500, that's telling you that there is no equity risk premium, and you are paying through the nose to invest in a riskier security, and that's not a bad thing if you're in a stage of the cycle where you can expect growth to remain robust or to accelerate. But all of the conditions that would describe the end of the cycle have been in place now for a number of months. Unemployment has been steadily rising. And investors, I think, have continued to choose to believe that a soft landing is the likely outcome, merely because it suits the positions that they're running, not really because there is solid evidence or solid historical analogues for that.
You know, it's interesting when you see the morning's jobs numbers come out and it become weaker than many economists had expected here. Danielle, you've been warning of kind of the bifurcation of the consumer, but how much worse do things get now that we're starting to see a more significant weakening of the labor market?
Yeah, look, the numbers were weaker today. We're not macro forecasters, but it wasn't particularly surprising to us, just given that we have seen divergences in the data from the establishment and household surveys. We've seen downward revisions to the establishment data before, and this is overall a trend that we've been eyeing for some time. I agree with James, equities need growth to work. And today in credit, you can get such a high income from high quality paper that you're being kind of paid to wait and be conservative. There could be more dislocation in the market ahead. It's a good idea in a portfolio to have some cash or some short duration investment grade paper that you can sell in a time of a dislocation. But generally, we're in an environment where we want to wait and see, and we want to prioritize credit selection and active management.
You know, it's interesting, James, to that end, how much cash would you hold at this moment? And is it for the purposes of waiting for some powder to stay dry for those dislocations to materialize, or because cash isn't that cheap right now?
No, I mean, that's true. Obviously, when you're a professional investor, generally you've got a mandate, and that doesn't always allow you to hold significant cash. I think as a person in the streets, investment cash has been a very attractive place to be invested because it's higher yielding than all of the government bond curve, and it obviously buys you optionality. But I actually think we've sort of passed the moment where cash is the favored place to be. I think duration has increasingly looked attractive because it has been so cheap relative to equities and relative to corporate bonds. High yield spreads have been very tight, investment grade spreads have been very tight. And what we see in these sort of risk off or growth scare bond rallies is not that credit doesn't participate, it does to some degree, but those spreads move wider. And so the opportunity cost of holding riskier securities rather than government securities, or indeed the opportunity cost of holding cash, has been pretty large over the last month or so, just because yields in core government bond markets have moved down so quickly. So I liked duration. We continue to like duration. Maybe the market is a bit over its skis in the short term, but we'll certainly use backups to increase our duration position.
Danielle, what's a risk that's more worthwhile to you? Is it taking on more duration risk when you're picking out credits, or is it credit risk?
I think it's both. I think in this type of a market, it's been overly accommodative to borrowers, where you just haven't seen the cracks emerge that we would have expected in this cycle. But with rates and restrictive policy and still high, some of those borrowers have unsustainable capital structures, and it's going to get worse, especially in more cyclical sectors. So take a building products company, for example, that's done quite well over the last few years coming out of COVID, as people were home and spending money on their homes to improve them. With rates so high, they're not moving and buying new homes. And so they're not going to be having that same type of discretionary spend. And so we see this type of discretionary spend eating into revenues, and we're asking ourselves, can some of these levered companies withstand a 10 to 30% hit to revenues? What does that cash flow look like? And as always, we think credit selection is going to drive returns because you're avoiding defaults to capture that higher income. But in the market today, where we do feel we're at peak rates and the next move is likely going to be down, not up, having duration in the portfolio is great. And we do that through having high yield bonds and some investment grade. When you have a multi-strategy portfolio, you have a lot of different levers that you can pull to keep the engine going in order to generate that high income for your investors.
Danielle, we thank you so much for your time. That is Danielle Poli, Assistant Portfolio Manager with Oaktree's Global Credit Strategy, and James Athey, Marlborough Co-Manager of Global Bond and Bond Income Funds. Of course, credit markets going wild after that jobs data this morning. Getting a check on markets as well, because between the earnings story and the economic story, you are having quite the sell-off here in the equities market. The S&P 500 dropping 1.9% now, and the NASDAQ 100 still flirting with correction territory, down 2.3% on the day. That two-year yield has just been stunning at 3.92%. Remember, we started the week closer to 4.4%. The 10-year yield still down almost 15 basis points. We're going to talk a lot more about it, but coming up, we're also going to talk more about earnings, because we have Booking President and CEO Glenn Fogel joining on the heels of a soft outlook for the travel company, a big look in how consumers are operating in an industry that people have been very excited about a rebound. We'll talk about that next. This is Bloomberg. This is Bloomberg Markets, and I'm Shonali Basak. It's time now for the stock of the hour. Like the overall market, Booking shares are sliding, wiping out gains for the year. And this company comes after the company announced a lower than expected forecast for the next quarter. Booking, though, did report second quarter earnings that mostly beat analyst expectations. Joining us now is Booking CEO and President Glenn Fogel. And we were talking a little bit during the commercial break, near term versus long term, how you think about the volatility ahead. When you think about the current quarter here, what was it that really guided you to beat before we talk about the forward look?
Well, we were very happy, and thanks for having me. We were very happy with the second quarter results coming in above expectations on most of the major metrics. The one metric where we came in line with what we had told the street last quarter, we gave a projection that we pretty much hit the middle of it, was because the airline tickets were less than we thought they'd be. Air tickets, especially in the U.S., have dropped a bit. But for us, that's not a big deal, because we don't make money based on the price of the tickets. So it really didn't affect any of the other metrics. It didn't affect revenue, doesn't affect EBITDA. We came in with very good EBITDA numbers, well above expectations. But sometimes the street, takes a look at that, but much more so looks forward, looks what we said about the third quarter, and they obviously said, not so sure about the future. I, of course, don't worry too much about the short run. I worry more about the long run. Long run is still well intact.
Well, let's talk about the medium run. You looked at the employment numbers this morning. You have a whole market that is pretty spooked by the slowdown that we're seeing. It all came in below expectations. And the real worry here is if you have wage growth moderating, if you have inflation moderating is a good thing, but you still have that pressure of higher interest rates for now. That could be an overhang here of anyone looking to perhaps buy a trip on a credit card. When you look at the employment numbers as a CEO here in an industry where people are looking to spend that extra dollar, do you worry that things are slowing down?
Well, there are a couple of things to think about on that, especially about our company. We're extremely global. So it's interesting, people, when you have a discussion about unemployment, we're talking the U.S., we're not talking global. And yet, for our business, it's very global. So yes, the U.S. is a big market, but it's nowhere near what our full global business is. So it's one small part. And yes, people are talking about sort of a two-speed economy in the U.S., where people who are having a little harder time at the lower part of the economic spectrum. That's true. But again, for travel, a lot of those people weren't traveling to begin with, unfortunately. They weren't able to travel. So the fact that they still can't travel, not as big a deal. What we talked about in our call was that we had not seen, in terms of globally, any real reduction in star rating, nor have we seen a reduction globally in terms of length of stay. Those are two metrics we look at in terms of a canary in the coal mine to see if there's a pullback in travel. So overall, we did mention a little bit of a mild moderation in Europe, but again, not a big deal. But I think people, they jump on any sort of news, short-term traders jumping on it, moving quickly. For me, long-term is what matters.
What gives you the most confidence here that the consumer in the United States would stay strong enough to kind of keep the rest of the year going? At the end of the day, when we talk to a lot of travel companies, there's still a set of confidence here that people want to get out there. How do you balance the pressure that consumers are under and their inclination here to get on the road?
Yeah. So here's the important thing, the way we look at this as we try and manage this company for the long term. And that is a couple of trends. One, travel over the long runs always increase more than GDP. So as long as we have a belief that in the long run, GDP is going to grow, travel is going to grow a little bit faster. Then a tailwind for us is that we are a digital player. So do you know it's still approximately half of the people do their travel offline? So that's a tailwind as those people come online, buy stuff digitally. Those are people who come and use us. Then you go into things when you look globally. There's a lot of people around the world who are just beginning to enter that economic level where you can travel. That for us is another positive. Then you throw on the great technological changes that are happening, AI, things like that. That's going to reduce our costs. And it's also going to make it a lot easier to do things like complicated travel, things that we would really be able to do much better. Bring more people to us versus our competitors. Why? Because we have the experience in doing AI. We're the biggest travel company in the world. We have the scale. We have the AI resources. So again, another positive for us. So I know there are going to be ups and downs in terms of travel in the short term in different parts of the world. The U.S., maybe there'll be a little slowdown. Maybe there won't be. Long run, it's not going to matter. It's all going to average out in terms of these low volatility pieces, and we'll still do very, very well.
Do you think that anything needs to change through the end of the year? If you think about pricing or if you think about incentives, is there anything we'd want to do to bring more people out?
Well, you know, one of the great things in our business is that we do provide different ways for our suppliers, airlines, hotels, car rentals, ways for them to get more demand when they need it. So it's a little counter-cyclical. So if the economy starts going down and if travel starts to pull back in an area, we have lots of ways for the different suppliers to use different ways to get business that they may not be able to get otherwise. One, for example, is a thing we call our Genius program. More companies will come into our Genius program, meaning they're going to give discounts to our Genius members. Another thing is special rates to buy on mobile devices, or perhaps certain geographical special prices. Lots of different ways for companies who need to get more demand to use our services to get more for them. And that's really what we'll see. And I think maybe we saw a little of that in the airline tickets starting to drop because not as much demand as they thought there'd be.
Glenn, we have to leave it there. Glenn Fogel is the president and CEO of Booking. We thank you so very much for joining us on the heels of another earnings report. And coming up, we're going to talk about Elliott Management calling the AI hype a bubble. NVIDIA shares are under pressure. We're going to discuss how hedge funds are grappling with the tech sell-off. And let's look at that sell-off as we head to break as well, because we're watching the S&P 500 now down more than 2%. That NASDAQ 100 down 2.5%. That Russell 2000. Remember, we were watching a market here that people really flooded into those small and mid caps, now down 3.3%. And the VIX at 25, just stunning. You have to understand that VIX that high could have some interesting implications if it holds steady into next week for capital markets activity that we have seen coming back. We will bring you more markets as they come. This is Bloomberg. This is Bloomberg Markets, and I'm Shonali Basak. Elliott Management, that's Paul Singer's hedge fund firm, is reportedly telling clients that NVIDIA is in a, quote, bubble land, and it's skeptical of the AI hype. Take a look at NVIDIA trading volume today. The blue line on this chart shows that average volume throughout the day, and the white line is today. The Bloomberg estimates more than 500 million shares will be traded by 4 p.m. Bloomberg's Hema Parmar reported on all of this, too, and want to kind of touch back at the note that Elliott was saying here. Elliott being kind of one to lean on the fear factor is not strange for Paul Singer and Elliott. How did you read this note reported by the Financial Times earlier today?
Yes, so the F2 report said that Elliott came out here really being, not unsurprisingly, bearish on NVIDIA, saying that he's very skeptical that companies are going to still be relying on the processing units. He says that AI is overhyped, that the applications aren't ready yet, that it's never really going to be cost-effective AI technologies. It's not going to work right. It's going to take up too much energy or be untrustworthy. So some really bold language here when we look at the bearishness on NVIDIA, very likely why that stock made up only a tiny portion of their portfolio as of March.
Right, so good point there. They were in it, but it's interesting to see if they, as an activist investor, will get into any of these stocks as well. I also want to talk a little bit broader about the hedge fund industry right now, because you had a great report about Coatue in the last 24 hours here. Big tech was pretty decent this year. How are we seeing companies starting to get burned?
Yes, so a lot of the hedge funds that we talk about, especially the stock pickers, are all invested in their biggest companies, in the tech companies, Meta, Amazon, Microsoft. So when we look at Coatue, they posted their worst monthly performance so far this year, last month, down nearly 4%. And what that means for their year-to-date returns is it brings it down from about 9 to about 5, excuse me. And their biggest stakes, Meta, Amazon, and Microsoft. And you see that now when we look at the other hedge funds too, Tiger, Lone Pine, Whale Rock, and Light Street, all in these big names in amongst their largest positions. So we can expect potentially more pain to come from such names as we wait for returns over the next couple of days.
Stan Druckenmiller looking pretty smart now for trimming that exposure a little earlier, even before that rally in the midterm. Bloomberg's Hema Parmar, we thank you so very much for your time. Of course, a lot of crowded names there, but we're going to look at some more crowded trades here. We want to pull up the board, pull up the bond market. That is where we're seeing a ton of moves here. The 2-year down closer to 390 on the day. Cross asset moves are kind of crazy. Brent crude down to the 76 handle, and the VIX even higher now to 26. That sell-off has been intensifying all day. We'll keep an eye on it through the close. Of course, these moves come on top of a tough day yesterday as well. Tough way to end the week, but of course another week ahead. Have a great weekend all. I'm Sonali Basak. That does it for Bloomberg Markets, and this is Bloomberg.